Hello, everyone, and welcome to our complimentary virtual seminar on the power of your money. We are delighted you are joining us to discuss this important topic in planning for your future. I'm Mare Mazur, President and General Manager of Vegas PBS. As a public media service, we are committed to providing resources and programming that educate and empower everyone in our community. Seminars like this could not be possible without the support and expertise of our Planned Giving Council members who volunteer their time to help educate our audience. The seminar will be presented by three trusted and well-respected members of the Vegas PBS Planned Giving Council, Mahesh Adrani, Jason Oceans, and Shauna Waldman. Today's seminar will be presented in three segments, with each guest giving a short presentation on the power of your money. Toward the end of the program, there will be an opportunity for you to participate in a question and answer session. Now let's get straight to the program to allow enough time for you to answer your questions toward the end. I'd like to start by introducing our first presenter, Jason Oceans. Jason is a wealth management advisor and certified exit planner with Westpac Wealth Partners. He helps clients make informed financial decisions on wealth accumulation, distribution, and preservation. Jason obtained his MBA from the University of Michigan Business School in Ann Arbor, focusing on corporate strategy, organizational behavior, and marketing. He's widely published nationally and locally, authoring articles on estate planning, investments, insurance planning, and retirement planning. Please welcome Jason Oceans, who is presenting Investing 101 and Behavioral Finance.
Thank you, Mare, and welcome everyone. Before we get started, I just want to share that we're going to provide some information, some good information ideally, and it's pretty general, so make sure you speak with your individual advisor for very specific information. So with that, let's get started. With respect to investing, a lot of people aren't aware that there are different investment philosophies. So it's really critical that you and your advisor are philosophically aligned. So for example, on one hand, you have active-based investing, which embraces picking stocks, picking when to be in and out of the market, when to be in and out of different sectors. And then on the other side, you have the argument that the market produces the results. So again, it's very important to make sure that you and your advisor are aligned. So let's get started. When we're building a portfolio, we start by owning equities. And this is an argument for capitalism. It essentially says that innovation occurs. We don't know where the innovation occurs, but there will be new products, new services, and there will be new value that's created. And we as individuals participate in capitalism by owning equities. And then we reduce the risk by also incorporating fixed income. So when you see a portfolio, for example, that's 75-25, the first number represents the equity position, and the second represents the fixed income position. And again, the purpose of the fixed income is to reduce the volatility, which effectively means that it's math. You're reducing the standard deviation, the expectation of how much it goes up or goes down in any given year. Secondly, we diversify. And everybody's probably thinking, well, yes, of course we diversify, but it's not just owning a lot of stuff. It's being very measured, very mindful, very thoughtful. And as you're building a portfolio, you look at different asset classes, which are holdings that have common characteristics, and you want asset classes that behave in different ways, so they complement one another. An example, I lived in New York for many years. I used to go to Yankees games, and it rains during the summer. On my way there, I would often see different people on the corner selling umbrellas and also selling sunblock. When it was rainy, they would sell a lot of umbrellas, and on the days that it was sunny, they would sell a lot of sunblock. So it's those complementary assets or complementary revenue streams that they have that are similar to when you're comprising a portfolio where you have different asset classes that enable you ideally to maximize the return for any given level of risk. Again, it's math, or to reduce the risk for any expected rate of return long term. Then next, we look to rebalance. So what we know about a portfolio is that the asset classes comprising the portfolio don't move in the same direction at the same time. So what happens is they tend to drift. So if you have a portfolio that's ideally academically sound, there's a certain threshold for each different asset class, and over time it'll lose alignment, which, as it implies, increases the risk level of that portfolio. So complete oversimplification, and I'm not proposing that this is what your portfolio should look like, but let's say that you had a portfolio that was 50% US and 50% non-US. Over time, if you went away for a year, you came back and you had this portfolio that now had 70% US and 30% international, it would no longer be in alignment. So that would require, in order to get back into balance, selling what's high, the US, to buy what's low from a relative perspective to get back into alignment. So when this is done mechanically and thoughtfully, it will produce a result where you're invariably selling what's high and buying what's low over and over. And then lastly, we are human, and this is the most difficult part. The first three, it's sort of like following a recipe where we can do that, but the last part is the human element. It's the art component of what otherwise is scientific. We're human, we behave. When something feels good, we want more. When something feels bad, we want less. And we make decisions that aren't necessarily in our best interest. So the example I always give, because invariably it's true, I know that to be healthier, I need to work out more, I need to eat better or eat less. And invariably, 2 nights ago, I had ice cream. So I know what's good for me, but I don't necessarily follow that. That's what we do as humans. So if we go to the next slide, what we see is, as you're looking from left to right, you see the last 20 years. And when you look from the top to the bottom, you see the various countries. And what you'll note is the top is the best performing country that year, and then the bottom is the country that had the worst performance in terms of its market. And we are pattern making machines as human beings, and what you'll notice is it's really obvious what the pattern is, right? There's nobody who can consistently determine and project what's going to happen if we were to continue moving left, and including 2022 and 2023 and 2024. Ultimately, what we're looking at is a really pretty quilt of beautiful blue colors and green colors. But we as humans try to create a narrative and try to create some type of pattern which doesn't exist. And if we look at the next slide, what we see is that when we attempt to game the system and we attempt to move in and out of the market, good things don't necessarily occur. So this shows over the last 30 years the performance of $1,000. And what you see is, over that period, if you had stayed true, then that $1,000 would have grown to $26,000. However, if you just missed one day out of 1,000, so the best day out of 1,000, then you would have given up 10% of your returns. And then to follow, if you had missed the 5 best days over 1,000 days, then you would have given up 40% of your returns, and so on and so forth. So what it lends itself to is the idea that it's really, really difficult to project what's going to happen to a time when to be in and out of the market. So as we know, and as the data suggests, it's mostly behavioral once we are in an academically sound portfolio. And there are different biases, there are different behavioral issues that most of us are guilty of. And what I'd suggest is, as I'm going through these, I'm going to briefly describe them. I just want you to jot down those that you think might describe you at various times. So if we go to the next slide. The first is confirmation bias, and that's our tendency to surround ourselves in an echo chamber. So certainly from a political perspective, we see this all the time. We turn on the news that supports and reinforces our belief system. We surround ourselves often with friends, or we read articles that merely reinforce our belief as opposed to seeking to refute. We look to confirm, and that can be dangerous. The second is fear of missing out. And that's the idea that there's something happening that we're on the sidelines not enjoying. So if you think about that hot stock pick or game stock, or move in the market or move out of the market, or buy this or buy that, it's this fear of missing out. It might not lead us to making a thoughtful decision or the right decision, but it's that fear that presents itself. Next, we look at hindsight bias, and we have a tendency to look at what occurred in the past and sort of create a logical narrative. So if something happened favorably, then we ascribe a predictability component to it. Yet if something didn't work out in our best interest, oftentimes we'll say that it's random or we can't make sense of it. Next, we have gambler's fallacy. And think of it this way: if you flipped a coin, you have a 50-50 chance of it being either heads or tails. If you flipped it 5 times in a row and got all heads, what would be the likelihood of having tails on your 6th flip? So consider this. It's easy to incorporate what occurred the first 5, but in actuality, it's an independent incident. So there's still a 50-50 chance of that happening. Next, we have action bias. And what I'd say is, don't mistaken action for progress. So oftentimes being disciplined and just staying true and sitting in our seat feels like we should be doing something. And oftentimes what we'll do is, it's almost like grabbing a bar of soap. The more we rub that bar of soap, the less we have. Oftentimes when we act, and we act out of fear, then bad things happen and we end up with less. And then lastly is recency bias, and that's tendency to apply greater prominence to information that we heard recently. So we have this historical database in our minds of knowledge, and we have access to what we've learned, and then we have something that becomes front and center, and we then lend too much credence to that. So I know that that was a quick summary of how to create a portfolio and how to have a good investment experience. And then we talked about some of the behavioral components, but I hope that was helpful. And the 3 of us on the stage, we're certainly available if you do need any assistance or you have any follow-up questions. Thank you.
Thank you, Jason. That was such great information. And as a reminder, for those of you joining us today, please submit your questions in the chat feature. We'll get to as many of you as possible during our question and answer session toward the end of our seminar. And now I would like to introduce Shauna Waldman. Shauna is a financial advisor with Raymond James Financial Services. She uses a holistic approach, considering the client's total wealth framework, not only investment accounts, but mortgages, retirement and tax strategies, healthcare, long-term care, and estate planning. Shauna is a Las Vegas native who graduated from UNLV with degrees in economics and finance. She enjoys giving back to the community through her work with local nonprofit organizations. Please welcome Shauna, who will be presenting more on behavioral finance and market volatility.
Thank you, Mayor. Appreciate it. And thank you, everyone, for logging in and tuning in for the seminar. We really appreciate having you here to learn from us and then to submit questions for us afterwards. So I'm going to be talking about volatility, which is definitely something that we have seen a lot of in the market recently, and go through some of the things that create volatility within the marketplace, and at the same time also look at what happens when you react to that volatility in a less than optimal way. So as you can see, that's pretty much what I feel like today, as we had a down day, and this is normal. If things are positive and you're feeling good about yourself, your job, your financial situation, and it's tied to the market, you're happy. But then when things pull back and you get your statement and it's down, you start to suffer distress. All right, so some of the things I think are really important for an investor is that you keep things in perspective, and doing that oftentimes will come if you have someone to talk to, your financial advisor, someone else who's been in the market a long time, so that you can discuss what's going on. And remember that we have been through volatile time periods before, many, many times. This is normal part of investing. And that it's very difficult, as Jason was saying, it's very difficult to time when you get in and out of the market. So talk to your trusted advisor and review your plan, make sure that you're on track. And that includes remaining disciplined, rebalancing your portfolio, as Jason talked about, and making sure that what you have in your portfolio will provide what you need for your long-term goals. And yes, there are many different kinds of markets. There are times when some things do better than others, and you need to adjust your portfolio accordingly. So Jason talked about some of the biases that we have, and additionally, we also have the fear or flight tendency as human beings, that when things are negative or we are fearful, you get tripped up in thinking, okay, I need to get out of here, I need to get away from this. And this is very much covered in behavioral finance. One of the things that is important to do, probably more often than not, is really sit and ask, what is my best move? Do I need to make a change? Because oftentimes doing nothing is actually in your better interest rather than making the situation worse. If you're hopping in and out of things that are doing well or doing poorly, thinking that that's going to improve your performance, you can end up compounding the negative effect. One question might be is, how normal is market volatility? And that is something that people think, oh, the S&P is just going to go up all the time. The market's just going to keep growing. Companies are doing well. They're paying dividends. And particularly the last couple of years after the pandemic, with market having really wonderful returns, for people who haven't been in the market over the long term, they may not realize that declines in the market are actually quite normal. A pullback, which is 5 to 10% decline in the market, normally we have that at least once a year, sometimes twice a year. A correction is a decline of 10 to 20%. And again, this is not abnormal. And then a bear market is when the market recedes 20% from its previous high. And I will confirm that today was not the first day, but we're definitely in a bear market presently, with the S&P and the NASDAQ having pulled back more than 20%. So one of the questions might be, well, what causes that market turmoil? And several different things could potentially be triggering that. Liquidity risk. Liquidity risk is really what we saw during 2008 when the bond markets and stuff froze up, and that was what drove that event. Market risk. Right now, the Federal Reserve fighting inflation, raising interest rates is definitely having an impact on the market. And I think we talked about, Jason had mentioned what happens over time. The market can essentially look back on history and see what has happened. So for instance, if the Federal Reserve starts raising interest rates, you can look back and statistically say that, well, within 7 to 24 months, 70% of the time you have a recession. And it seems to me that the market has pretty much said, okay, let's just get this over with now. And they haven't even had that much time for the Federal Reserve's rate hikes to have an impact on the market. and yet the market is acting as if we were already in a deep recession. So operational risk is more related to each individual company as far as bankruptcy, and then credit risk applies more to your bonds and fixed income. And again, that would be whether or not the company is going to be able to continue paying you your interest and redeem the bond when it's scheduled for maturity. So loss aversion, this definitely, it's very interesting. There's a couple of psychologists, Kahneman and Tversky, who studied this and found that human beings would actually, the fear of loss is twice as powerful psychologically as the good feelings we get from gains, which basically during their study, they found that people would rather not earn something or gain something if it meant that there was a risk of a loss. That's how much we are averse to losing. However, it is normal, part of investing, and it can oftentimes provide us opportunities to buy things on sale. All right, so volatility. There's a number that we do look at when we are looking at volatility on the market. I'm just going to touch on it briefly. It's called the VIX, and it measures volatility within the marketplace. Right now we're trading at about a 33 on the VIX, and on the next graph you'll see that when we are above 30 with the VIX, we tend to have a lot of volatility of interest. During the COVID crisis, I believe we hit a VIX above 80. 20 indicates low volatility, but like I say, we're trading currently about 33 at the market at the moment, and that's why we're seeing a lot of volatility. This graph is really nice. I know it's long-term, it's 1940 until 2020, but it shows that over time, even though we have pullbacks in the market, even though we have recessions, even though there may be something negative going on, and we do pull back in the market, if you stay with your investment thesis over the long term, that volatility gets smoothed out so that you come out ahead, and the whoop-de-doos get, like I said, smoothed out and minimized. So planning for different markets. Jason had shown you the color chart of the different countries and how they performed. This graph shows you diversification can help smooth the ride, because we don't know what's going to be the top performing asset class every year, and that's evidenced by this chart. But if you look at the kind of the not medium blue color, which is a blended portfolio, it's never going to be at the top, but it's never going to be at the bottom. So that's why you want to diversify your portfolio, rebalance accordingly, and you'll smooth out the volatility and not suffer severe losses by only sticking to one asset class. So again, we're just reinforcing the value of diversification. Just like your grandma said, don't put all your eggs in one basket, and you'll get smoother returns with a diversified portfolio. All right, and the next chart is going to show us that how a balanced portfolio recovered after severe stress in the market. So the first one, October 1987, we had that 22% day when the market dropped in one day. Yet if you maintained your portfolio over the long term, you can see that within 5 years you recovered 90%. So again, this emphasizes each time that sticking with it, you will come out ahead. So if we can skip forward a couple of slides to the next graph, don't lock in losses. One of the things that is always disheartening and frustrating, both for investors and for ourselves, is when clients panic and want to get out of the market. Because it may be easy to get out of the market because your fear is driving you to make a decision, but deciding when to get back in, usually you make the mistake of waiting to see that the market has recovered. And in doing so, you lose out on a lot of gains. So this chart shows that, since the great financial crisis, had you pulled out your money and stayed in cash, you would have missed out on an incredible return in the market and exiting. So your best goal, best outcome is going to be stay in the market and to stay diversified. Okay. And investing for the long term, we've already gone through that. I think we all had that. And then let's see, the next one, fight fear with facts. There's a lot of noise out there. We're all bombarded constantly with news, websites, text messages, and everything. Sometimes it's necessary to just turn off the noise and try to unplug from it and don't let it be a driving force to make things more convoluted. Okay. So best thing to do is pretty much what we've talked about all along, is to stay diversified. When opportunity knocks, that's one thing they say about stocks. When stocks are on sale, that's like the one asset in America that people don't want to buy. If it was Neiman Marcus or TJ Maxx, you'd be running to the store. But when stocks go on sale, people are adverse to buying them, and that's a big mistake.
Oh gosh, thank you so much, Shauna. Now, just another friendly reminder to please submit your questions into the chat feature. We'll go to as many as possible during our Q&A session. And thank you to all of those of you who've been sending them in. And now to our final presenter, Mahesh Adrani. Mahesh is the founder and president of Strategic Wealth Design, an independent firm in Las Vegas. The firm specializes in working with its customers to help them reduce taxes, optimize savings, and invest efficiently. He is a certified financial planner with over 17 years of industry experience. He's passionate about leadership and is naturally drawn toward helping and leading organizations in his community. Please welcome Mahesh Adrani, who will be presenting Compounding Charitable Strategies.
Thank you, Mayor, and thank you, Jason and Shauna. It's a pleasure to be here, and thank you to the audience for attending at our session today. So it is my pleasure to talk about compounding your wealth and different charitable strategies. So the power of compounding, it's important to understand it because it helps you grow your wealth. So next slide, please. Before we jump into the presentation, just a quick disclosure that please don't consider this investment advice to your specific situation. Please speak to a qualified individual regarding your situation so they can give you specific advice. So next slide. So Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. So our goal today, and my goal today, is to help you understand the power of compound interest. Next, please. So compound interest, just on a high level on the basics of compound interest, it's basically earning interest on interest. If you invest, let's say $1, and you earn interest on that dollar, and you take that interest versus spending it, and now you in fact go ahead and reinvest it back into whatever investment it is, that's going to earn additional interest. So compound interest at a high level, the basics is it's interest on interest. With compound interest, the key is that time is your friend. And the more time you give it, it's going to have that snowball effect over time. Now, you've seen a few slides that my colleagues and my peers have shared with you. I'll certainly show you a few more slides as well. But that is the power of compound interest, that if you give it more time, it'll have a snowball effect, and it really rewards the patient and the discipline. So if you're patient with your investment and disciplined, it will turn around. Now, the challenge is, as Jason and Shauna talked about, was the behavior. Are we behaving? Are we being patient? Are we being disciplined with our money and our wealth? Next slide. So to get a better grasp of compound interest, we have to take a look at simple interest as well and have an understanding of how simple interest and compound interest works. So on this slide, in this chart, what you see is we have a column for simple interest, and we're assuming we take $10,000 and we invest it at 10%. So I know 10% sounds too good right now, given everything that's going on. So this is just an example. So simple interest at 10%, and if you see in the first, we put in 10,000. In first year, we earn $1,000, and that's our interest. And that's all we'll earn of simple interest is $1,000, and we'll keep adding it to the account. So it's based off of the original investment. There's no compounding happening in the simple interest account. Versus if you now put your money in a compound interest account and earn that same 10% interest, you'll see that in the first year you earn the same $1,000. But in year 2, now you're earning interest on interest. Instead of just earning the $1,000, now you're earning 10% off of $11,000, and you're earning an additional $1,100. So as you can see, the power of compound interest over 30 years. Simple interest will only generate about $40,000 for you from that original investment, versus if you had compound interest, that could grow to almost $175,000. Next slide, please. Now we talked about time. The more time you give it, the better off the results could be. So here we're looking at an example from investor.gov, and you put in $10,000, and this example is showing earning 9%. So if you over 5 years, you'll have amassed $15,000, and as you can see, the more time you give it, the more you amass. Now the key here is understanding the power of time, and Shauna talked about it, Jason talked about it. The key to this chart and understanding what's happening in the markets today is behaving and keeping time in perspective. Next slide. This is the same slide that Shauna had it on her presentation, Jason had it as well, and just a different perspective on looking at the markets. So what matters in investing is time in the market. Trying to time the market and going in and out historically has shown to generate poor results. This is showing if you invested $100,000 and you kept it invested over 10 years. So this is investing till December 31st, 2021, and the 10 years prior. So if you invested $100,000, you would have amassed about $462,000 in this case. But if you just missed the 10 best days in the market, and you can see the performance was probably down by about almost 40%. And what if you missed almost 40 days of the market? You only had a third of what was invested. So it's important to understand that time in the market is more important than trying to time the market. Next slide. Now, I know Shauna talked about volatility, and this is to give you some perspective. Life is short, and we have to decide what we want to focus on. This week and this pretty much entire year, on the left-hand side, you see what the days look like. It's the nonstop noise and the volatility in the market that we see. Versus if you just look at all the beautiful charts that all of us showed, showing the growth over time, and you can see what the decades can bring to you. So life is short, and we have to decide what we want to focus on. Do we want to focus on just the days and the noise that's out there, or do we want to focus on what the long term and focusing on the long term? So just to give you perspective on just the recent volatility. Next slide, please. So we talked about the compounding effect and the power of compounding. We talked about the perspective on volatility. Now I want to pivot to charitable strategies. The reason being, as you use compound interest, as you use compounding, it's going to create wealth. And you have a choice to either leave your wealth to Uncle Sam, to the IRS, to your family, or perhaps a charity. And I want to cover a few charitable strategies. I'm going to cover one charitable strategy, but on the slide, next slide, please, I will talk about the different options available to you. So one of our Plan Giving Council, Russ Cost, had a webinar. You can watch it on the website as well. It's a little plug for all the previous webinars as well. You can watch one of the videos and the webinar that Russ hosted, I believe in January or February of this year. And he talked about quite a few of these. And there are several strategies, charitable strategies available to you to take care of your favorite charities. And shameless plug, we hope Vegas PBS is one of them as well. So next slide, what I'm going to focus on is a donor advised fund. So next slide. If you haven't heard of donor advised fund, let's talk about some of the benefits of donor advised fund. So donor advised funds are basically a fund that is organized or sponsored by a 501c3 charity. And the benefits of donor advised funds, they walk and talk like a charity, and you can donate to it. You can get your charitable tax deduction today, and you can donate assets, so cash, securities, potentially other assets as well, depending upon the donor advised funds. Your assets can grow tax-free. So when you put in a donor advised fund, what you're doing is you can it functions as a conduit for other charitable gifting down the road. So you can fund the donor advised fund, and then you can direct the fund to give to your favorite charities over the years. And it could be a great tool for creating family legacy and teaching family members and kids and children about giving to charity. Some of the limitations of a donor advised fund, that it's a one-way street, just like any charitable donation. When you put assets or make contributions to the donor advised fund, it goes in the fund and it stays in the fund until you direct which charity you want the funds to go to. Now, a donor advised fund, unfortunately, one of the limitations is you get limited investment options. So you do have options of investing into traditional mutual funds and ETFs. A few donor advised funds may allow you for other options. But the key is, because these are investments, these are able to grow tax-free. So you could put the money in, they grow tax-free, and then eventually you can direct it to be given to your charity. Next slide, please. So the donor advised fund, how it works is the donor would be you, the audience, would give to and donate cash or property to a donor advised fund, and you will receive that income tax deduction today. And you can direct the donor advised fund to grant funds to the charity, which would go to your favorite charity at any time. Next slide, please. These are some strategies regarding donor advised funds to keep in mind. Now, please speak to a qualified professional to understand how these strategies may work. With donor advised funds, you can, just like any charity, you can donate appreciated securities. So if you have gains, and I know the markets today, we may not have a lot of gains in our securities, but if you do have gains, you do not want to pay capital gains on that. You can donate that to charity or a donor advised fund, and the tax gain is not recognized. If you have a high income year and you have a stock or a bonus or a stock option exercise, or you have realized capital gains from sale of real estate or a business, you can front load charitable contributions into a donor advised fund. So for example, if you have a favorite charity that you donate, let's say $10,000 every year, you could front load, let's say $50,000 for 5 years worth of donations into a donor advised fund. And then over those next 5 years, have the donor advised fund grant that $10,000 per year to your favorite charity. Slide, please. Next is you can pair, if you're looking at Roth conversions, this year could possibly be a good option for a Roth conversion, only because the securities the markets have been volatile, stock markets are down, values are down, could be a good opportunity for a Roth conversion. If you are considering a Roth conversion, and you could pair it up with a donor advised fund contribution. Roth conversions are taxable. Donor advised funds or charitable giving is tax deductible. So those two could potentially offset each other. And lastly is looking at the lump and clump strategy. That's what we call it, for itemized deductions. So a lot of individuals don't take itemized deductions anymore, but if you do happen to take itemized deductions, you could lump and clump your charitable contributions in 1 year and then give that money to charity through the donor advised fund over several years. So that's pretty much what I had for today to talk about donor advised funds. And thank you again, for joining us.
Oh, thank you, Mahesh. This has been so interesting. Now, a final reminder to everyone, please submit your questions in the chat feature. As we transition into our question and answer session, I want to take a moment to inform you that the presenters today are offering a complimentary consultation to those who are interested in scheduling an appointment. To schedule an appointment, please stick around at the end of the presentation. Each of you will be given access to a seminar survey, which includes an opportunity for you to schedule that appointment. And now let's get to your questions. And we've already received some very interesting ones, and I know you're not going to give specific advice, but there's a question on a Roth IRA that was opened several years ago, and it's been fairly flat with no growth. The question is there advice about what I should do? I know you're, as I said, not giving specific advice, but could you comment on Roth IRAs as you just had mentioned?
So Roth IRAs, IRAs are great vehicles for individuals that don't know what Roth IRAs are. They are vehicles where money goes, you can fund a Roth IRA up to a maximum of $6,000 per year. And you fund it with after-tax dollars, all the growth is tax deferred and can come out tax-free at retirement. This question specifically was regarding investing, and the investment or the Roth IRA has been pretty flat. This could be possibly with the recent market volatility. This could be with the investments. Perhaps it's just sitting in cash. Many times I've seen individuals come and talk to us where we look at their statements and they didn't realize the money was sitting in cash. So investing could be an option for them, and taking a look at the different options available through the platform where they're at. But I would recommend they go talk to the company where the Roth IRA is held, so they can give them some specific advice.
Great, thank you.
And I think that has two different questions incorporated into that single question. The first is about a Roth. Does a Roth make sense? It's a great place to grow money and have it accessible without being taxed, so it should fit into an overall strategy. The second question is, what are the holdings inside that Roth? And that's something that I would encourage you to have your advisor reevaluate and assess whether it is diversified the way that it should be if you're not capturing gains.
All good information, thank you. Now here's a question on mortgages. Can you provide information on shared appreciation mortgages?
I have never heard of that.
I had never heard of it either, so I was hoping you could define it.
So I will say that I do not do mortgages or anything like that. However, I recently read an article that spoke about the woman that was profiled. Was in Southern California. She was in a situation where she, needed to access capital from her property, but her situation was such that her credit number, she couldn't qualify for a loan and get the money that she needed to make repairs. And there was a firm that was willing to look at the property, evaluate it, discount it, and then they gave her a dollar amount that represented a certain percentage of equity in the home. And then when she sells the home in the future, they will get repaid that way. I don't know about fees, in between or anything like that, but that's my understanding of something new.
Many mortgage brokers today are sitting there idly waiting for the phone to ring given the mortgage rates. So I would suggest contacting an expert.
Yeah. Oh, as always, good advice. And then here's a question about what are some of the most secure investments and what are the best tax-free investments? So, do you have your crystal balls?
Was it most secure?
Most secure and best tax-free.
Okay.
I'm gonna go for it.
No, you go. I'm gonna throw that one to you.
So secured investments, and if you define security, what type of security you're looking for. So secured investments are if you're just looking for FDIC insurance, that's a form of security, and you're looking for complete safety. From that standpoint, it's a bank savings account or a CD. If you're looking for perhaps a few more guarantees and a little bit of growth, then perhaps some insurance companies. The only two that I have noticed that can offer any type of security or guarantees are the banks, either in savings or checking account under FDIC insurance, or offering it through insurance companies where they're guaranteeing some part of the principal. There's a lot of moving parts to it, and but those are the only two that come to mind right now, at least.
Well, I think you could, so U.S. government bonds are considered essentially risk-free at the moment. So that could be an option as well for security. And again, you're going to have to analyze what the trade-off is and exactly what level of security you're looking for that meets your need. So
everything's a trade-off. So it's sort of playing a whack-a-mole game of what you're willing to trade off. So for example, if something's really secure, the more secure it is, the less likely you are to receive too much appreciation. There is no free lunch. That's what I'd say. And it's a function. So for example, if we think about today's world where we have inflation, if you're in cash or something that's cash equivalent, your money is not going to keep up with the purchase power that you need it to maintain. So it comes down to having a strategy where you have different components of your overall strategy. So if you do have guarantees in some form, or you do have something that's really safe and secure, it gives you permission to be a little more aggressive in other places. And then it's a function of the composition of the portfolio, where you can have a portfolio that's going to be comfortably volatile. Again, from an academic sense, that volatility is represented by a number, standard deviation. So if you're in the market and you can assume volatility, the requirement is that you have time. And that's made possible either by virtue of being in your working years where you're still saving, or by virtue of being appropriately liquid so you can turn someplace else and you're not in a position where you're forced to access your wealth in a down market.
That's all great information. So here's a question about, we keep hearing about rising inflation, and what is the best way to make this work in your favor? I think that's a good follow-up to what you were just talking about.
A way to make inflation work in your favor?
Yes, a way to make rising inflation work in your favor.
I think there are two sides to that. I think you have the accumulation side when you're saving money. So if we have inflation, it implies that our earning power also increases to keep up with that. So for those of us still who have kids in college and we're still for the foreseeable future working, then in theory, our income's going to rise as inflation rises. So then the other side is those of us who are in the position where we're accessing and enjoying our wealth. And on the one hand, more is always more, more is always better. And I think, again, I go back to the idea that you need to have a robust strategy. So if you're just dependent upon the market, you're at the mercy of the market. So if you have a strategy that has multiple parts, safe components, it's appropriately liquid, it has some that's in the market, because we know historically the market outperforms inflation so long as you have the time to have it reveal itself. And if you have some of your basic costs, your expenses addressed, then inflation's not going to hit you as dramatically, and you're not going to feel the same impact.
Looping back to the donor advised funds, is there a limit to the amount you can donate in a donor advised fund in any given year?
No, there's no limit to how much you can donate to the donor advised fund.
Okay.
It may only be limited by any charitable tax deductions, but from donor advised fund limitations, there are none.
Got it. And do you expect regular bank CD rates to rise much after Fed interest rates go up? It seems like some banks are sitting on a lot of money and have no need to be generous with CD interest rates.
They should. I mean, generally, as the Fed raises interest rates, the banks should be raising the rate of return that they are paying. But again, if the bank is flush with cash, they don't have to be increasing the interest that they're paying. But I do know that there's some money market funds out there that have definitely raised the interest that they are paying. And one thing I will mention, because it's gotten a lot of coverage recently with regards to inflation and how to make that work, is the TIPS, the inflation bonds that you can buy directly through U.S. Treasury. And the interest that they pay is, well, actually, what is 0% interest, but then there's a premium that's added depending upon what inflation is. So I believe they reprice every 6 months. So the number's moving, but I think the first half of this year, it was over 7%. But again, you have to buy those directly through U.S. Treasury, and you're limited to $10,000 per person per year, unless you have a tax refund, and then you can do another $5,000. So.
Wow. And the Fed's just increased rates by 0.75%. What does that mean? And, tying that into some of the other things we've been discussing.
One, I think it means that everything's going to cost more. So all types of loans, interest rates are going to go up, auto loans, mortgages, student loans as well, credit cards interest. So that's the one thing that's going to happen is everything's going to cost more from financing standpoint. But on the flip side as well, as we talked about, CDs and other vehicles would possibly pay more interest as well. So again, if the Fed rate went up by 0.75% doesn't mean everything is going to go up by 0.75%. There is a formula, and it just depends upon the banks and the interest rates and what's happening. And sometimes those things just take time to get implemented into the system as well. If they raise the rates yesterday, it doesn't mean we're going to see the impact immediately today on some of the interest rates at banks and money markets. That may take several weeks and several months for it to go through the markets and start showing again.
It sounds similar to something you were saying earlier, Shauna, about the markets sort of not waiting the normal 7-month period and just jumping right in. Right. So we're seeing a lot of
normally
reaction.
it takes they say historically, up to 6 months for a Fed rate hike to do what they're wanting it to do and have it be reflected in the data. So, and the reason the Fed is raising interest rates right now is because they are utilizing that tool in their toolbox to try and slow down inflation. So economic data that came out recently showed that, yes, we are starting to see slowdown in certain areas, but not enough. And energy prices and food prices are still much higher than the Federal Reserve would like to see it at this point in time.
Okay. Here's one final question on technology, and it says with technology and iPhones, it's easy to get updates on the market. And I think the question kind of implies, so how should or could a lay person be utilizing that easy access to technology and in collaboration with a financial expert to, sort of make themselves more in control or more aware, or I'm opining on the question. It wasn't quite.
I can
Yeah.
provide my input. So there's a gamification in our world where we have access to more information and more data, but we can't control any of this. And it just creates all of this anxiety. So I love when a client says to me, I don't really pay attention to the market because I understand we can't control what the market does. We can control being in an academically sound portfolio, and then I understand I need to behave myself. So it's important to recognize when you're looking at the headlines are just providing these inflammatory headlines to get your attention. And in terms of the data, if you really want to feel, if you're so inclined to feel as though you're aware, then maybe you can choose basic indices, but it still just creates that anxiety over something that you can't control. And then taking that one step further, when you, and I don't recommend anybody do this, and I recommend very few people do this, if any. If you are so inclined to choose individual stocks and to play the game yourself, what you'll notice is that the technology is such where it almost feels like you're playing this actual game, but it's a very expensive game. It's a very expensive game, and bad things tend to happen.
Well, you've all given us so many insights and so much to think about. Are there final thoughts? Would you like to kind of wrap up all of the different topics we've covered? Is kind of a steep assignment, but we do have a little time left. So, any kind of conclusions?
Well, I think that we've all emphasized the fact that having a broadly diversified portfolio, having a plan in place where you identify, what your intermediate and long-term goals are, and committing to that is going to be critical in helping you get to your end goals. And talk to the people that you have that you're working with, ask questions, and try not to let the fear have you making poor choices. That's just, and I know it's hard. I mean, this is a difficult time that we're going through. We've been through it, in March of 2020 when the market, dropped 35%. And we were all worried about, I think, much more than just the market. Was medical going to be able to figure out what to do with COVID? And then the market was off to the races. So just stay on top of what your goals are, and pay attention to your retirement planning and different pockets of what you have, so that you're not caught in a situation where you don't have the liquidity that you need when you need it. And that goes back to all of us building the portfolio. It's that pyramid, and you've got your cash and your more risky stuff, and then you don't have to get into it when things are negative.
Well, you struck on something that I thought was really interesting when you said that the stock market is the one place when there's a sale, nobody shows up, because, certainly, and you used one of my favorite words of Neiman Marcus, sale. So, let's end on an up note of, all right, there is this tremendous volatility, but if an investor is so inclined, what are the traits to look for in assets of, if you're going to say, I think I have a little extra that's not earmarked for anything urgent, what should I be doing?
I think all the points that we touched on, which was diversify, take a look at your long-term goals. Ideally, what do you want this money to do for you over the long term? Have a financial plan and see if this additional cash and where this additional cash fits in that financial plan, and work with a professional advisor, an expert that can help you craft and design that portfolio, and help you diversify. That's what we've been talking about, is diversification is key. I'm not a sports guy. I use a sports analogy. I know you're a baseball guy, Jason. So it's not about the home runs. It's about the singles and doubles.
When the market is volatile, there's a mass redistribution of wealth. That's what we see. We see people who are fearful, who leave the market. And I think as my colleagues highlighted several times, it's about having a plan, having a strategy, remaining disciplined, and that puts you in a position where you don't have to just react. And invariably, there's going to be something on sale, and always there's something on sale. Just by virtue of the relative nature of different holdings, even if everything's up, this is relatively cheap compared to this. So then if you're remaining true to that framework and that strategy, then invariably the rebalancing component gives you the ability to always buy bathing suits in winter.
And going back, so Mahesh was talking about compounding interest. One of the things that people sometimes don't realize is that the majority of the returns in the S&P 500 over the long term are reinvested dividends. So that's the payment that, if a company pays a dividend to you, generally 4 times a year, if you take that dividend and you're, reinvesting that dividend over a long period of time, you're going to buy more shares when the price is low, less when it's high. But that is truly compounding your equity investment. And that's, like I say, the bulk of the return from the S&P 500 is from those dividend paying companies. So look for some of those that are on sale.
Oh, all great insights, fantastic advice, and most importantly, so generous of you to share your time and expertise with us. Thank you so much. We're running out of time today, but if you have more questions, I encourage you to schedule a consultation with one of our presenters. Again, a survey will immediately deploy following this event that will allow you to schedule an appointment. I'd like to once again thank today's presenters for sharing their knowledge and wisdom with us. Please save the date for September 28th for our next in-person planned giving seminar on wills and trusts. I also encourage you to visit our website to stream Vegas PBS's new original program, Money Masters. This is a show in panel discussion of our local specialists who break down investments, taxes, wills and trusts, and overall life planning in an easy to understand format. The first episode, which premiered on May 20th, featured 3 money masters that discussed building and growing wealth, accessing and enjoying wealth, and transferring wealth and leaving a legacy. Visit vegaspbs.org/moneymasters to stream the series. Vegas PBS is proud to provide resources and programming that help you and the community at large find a path to financial literacy. Thank you again for joining us today. We hope you enjoyed this presentation, and until next time, have a great summer.